Paul, I won't ask you to weigh in on some of the serious shade that's been thrown there, but the difference between going through 2.6 and hitting 3, the 40 basis points, how important is it?
It's not much, but I think there is a point where I think the point they're both making is there's a point where there's got to be a cyclical change. You've got to think about where to put your money. There is an alternative to investing in stocks. Personally, I like the 3%. We've been to 2.6%. Yes, we saw buyers at that level, but we're very solid at 240 now, and I think 3% is where people say, you know, that's a really good yield. It's at that point that stocks don't necessarily fall over. You just have an alternative for investing. And I think that's the point they're trying to make. What I'd be worried about is if we just flew through 3.5, then it's a whole new story.
We'll talk about sort of the return when you come to these two bond kings and the battle there. Take a look at the Bloomberg here. This is the normalized return of Gundlach's performance versus Gross's performance. Double line versus Janus Capital. And you can see it, double line, just trumping him there. That white line, the blue line is Janus Capital. But it also just goes to show how hard it is to figure out this market when you don't know if the channel we've seen for 30 years is actually going to reverse.
I think the key is when you look at that performance and look, there's obvious respect for both managers and firms, but one of them is potentially more dynamic than the other. And I'll let you decide who.
The chart will.
But these are markets that you need to be dynamic in. And we are entering a higher period of volatility. The VIX at 12 doesn't tell you that, but anybody trading in markets knows that you've got to be very dynamic. We talked about tweeting, you know, day to day, et cetera. This is what's happening in the bond market as well. You can see it in the currency market in particular. And I think that ultimately we may see a lot more volatility in stocks. So this to me is about just being more dynamic in markets.
Paul, going beyond the 2.6 versus 3, Jeff Gundlach makes some structural points about why he thinks there's a limitation on how far you can go into equities out of bonds. Yeah. Both because, for example, central banks can't sell all their bonds and buy equities, just can't do it. And a lot of institutions are required to have a certain amount of fixed income. Yeah. Does that really deter the shift away from bonds and into equities?
Well, the one thing that I would, just to answer that in another way, think about the fact that a lot of fast money really caught onto the trends 2 months ago, but a lot of longer term money, real money as we call it, haven't necessarily made the portfolio adjustment yet. To them it's more prudent to wait to see, you know, once you've got the president in place, exactly what his policies are and so forth. So I think that's yet to come. And in that respect, I think that if we were to see very stimulatory policies that obviously we know are coming from Trump, and we're to see this this back up in yields, maybe up to 265, 270, then that question is going to be answered.
But to David's point, this great rotation, this theme, say you've got a portfolio with a 60-40 split, do you need to stop thinking about it as a switch out of bonds and into equities? And what Citi, I think, pointed out is a risk rotation within the asset classes. Yeah. So sovereign underperforms and high yield outperforms within fixed income, and then you look to the high beta plays in equity. Is that a better way to think about it?
Yeah, it is a way to look at it. It's funny, I did my yearly portfolio review with my wealth manager, and they're really trying to push you into equities because it's a reactionary stance. And okay, they might be very right, but there is a point, as I discussed with him, where yields can be very attractive to a balanced portfolio. And this is exactly what asset managers are going to do. And then within that portfolio, to your point, do you go into sovereigns, do you go into credits, into corporates? What's your view on energy, for example, particularly as regards the credit market? So all of that's coming. But I think we're still very much, we're maybe not tailgating anymore, but we're just in the first inning. It's so new. And 2 months ago, we didn't imagine this, and people are still reacting.